Hey everyone, welcome back to the channel. Today we're unpacking Patrick Boyle's eye-opening breakdown of the global debt bomb. And trust me, this isn't your grandpa's boring economics lecture. We're talking $200 trillion of government liabilities, bond market meltdowns, and why your morning coffee could someday be collateral in a sovereign default. Strap in. Imagine this. Over the last 25 years, governments have borrowed like there's no tomorrow. Patrick points out that public debt is set to top $200 trillion by year-end, and in the developed world, average debt to GDP ratios have rocketed back to 100%, a level we only saw in 1945, after 2 world wars and the Great Depression. Sound normal? It's not. Why the explosion? 3 seismic shocks. The global financial crisis, COVID lockdowns, and then the shockwaves from Russia's invasion of Ukraine. For a long stretch, interest rates were in freefall, so treasuries felt like free money. But the party ended when inflation roared back, and now any new debt gets priced in at sky-high yields. Despite that, governments can't seem to stop spending. Patrick highlights how 2024 was the biggest election cycle in history. 72 countries, half the world's population. Politicians lavished cash to win votes, and now the new office holders are racing to deliver on promises. Climate programs, gas price relief in Europe, ballooning defense budgets, all of it is driving deficits even higher as rates climb. Let's talk about the fallout. In the US this week, a $16 billion 20-year auction went soft. Weak demand, yields spiked, stocks and the dollar wobbled. Moody's promptly downgraded America's credit rating, warning that debt keeps ballooning with no plan to tame it. The 30-year Treasury yield has crept above 5%, meaning Uncle Sam's future interest bill just got a whole lot pricier. But if you thought U.S. bonds were shaky, buckle up for Japan. At its latest government auction, demand plunged to decade lows, sending the 20-year yield to its highest level in 25 years. And the 30-year and even 40-year bonds hit record highs. Patrick explains that the 35-year off-the-run bond now yields more than the 40-year simply because it's harder to trade. Investors are fleeing long-dated JGBs, terrified they'll get stuck holding illiquid paper as prices crater. Here's the kicker. Japan's debt to GDP has skyrocketed from 50% in 1990 to 240% today, the highest ratio on the planet. The US isn't far behind, creeping from 40% to 100%. And the UK, China, Brazil, France, South Africa, they're all piling on debt to fuel growth, even when growth is sputtering. Patrick flags the most stunning stat of all. Last year, governments spent more outside of crisis mode than ever before, and the biggest chunk of that spending surge came simply from higher interest on existing debt. In the US, interest payments topped $880 billion. More than we shelled out on Medicare and defense combined. Financial historian Niall Ferguson warns that any empire spending more on debt service than on its military risks, losing great power status. So what next? The IMF has waved red flags, urging a 3 to 4% of GDP fiscal adjustment globally, or tax hikes and deep cuts to prevent a full-blown debt crisis. But politicians hate pain now and promise it won't affect you. But markets don't forget. Bond vigilantes lurk in the shadows. When yields spike, even the sturdiest treasury can wobble. Here's what I'm watching. First, U.S. debt trajectory. The CBO now projects debt rising to 125% of GDP in 10 years, even without new spending bills. Second, China's fiscal target. They've already breached their 3% deficit cap and are aiming for 4% this year. And third, election aftermath. Will populist pledges to cut taxes and boost spending trigger another auction disaster? If you think this video is important, share it with your friends and drop a comment below. What scares you most about the global debt buildup? Don't forget to hit subscribe and click the bell, because when the next curveball lands, you'll want to know what's really happening behind the headlines. See you in the next one.